All right, we're on the last video for this chapter, and it shouldn't be a super long one, so that should be good news. So we're going to talk about expenditures subsequent to acquisition. So when you buy a building, other things need to be done to maintain that building or a vehicle. Most of us have a car. We live in rural Arkansas, so we have a car. If we might want to get the car wash done on it, there's a lot of little things that we could do that would just maintain the given level of benefits. But if we do something else to lengthen the life of that asset, make it last longer, make it more efficient, then we're going to capitalize it. Okay. When we say capitalize it, we're going to increase the asset's book value. Okay. Or we'll create a new asset. We go through a problem where they actually just have a whole new asset. Okay. Things like oil changes, car washes, painting the interior of a building, like, the walls inside that don't really affect anything, they just make it look pretty nice and clean. Those would be expense. So they would go straight to the income statement. When they get capitalized, then we have to calculate a new depreciation cost. Okay. Because we are adding more cost to it. Okay. What are some of the reasons why we have to kind of look at it and read the problems the same way? If it does one of these things, then it is capitalized. Okay. Does it extend the useful life? I kind of mentioned that. Does it increase operating efficiency? Sometimes putting a new roof on a building may make the operational efficiency a lot easier. Like it might be easier to cool in the summertime and easier to heat in the wintertime. Okay. It could be an increase in the quality of the goods or services that are produced by the asset. Okay. Things that are just repairs and maintenance that just maintains a given level of the benefits that we're going to get doesn't really increase the future benefits at all. Okay. Um, these expenditures for the activity should be expensed and in the period they occurred. Okay. So give us an example, an engine tune-up or a repair of an engine part for a delivery truck allows the truck to continue productive activity. If the maintenance is not performed, the truck will not provide benefits originally anticipated. So in a sense, future benefits are provided without the repair, the truck no longer, because the truck will no longer operate. Some things like an oil change, yes, it's going to extend the useful life of it, but it's also a very nominal amount. It's very immaterial. We're going to go ahead and expense it as it is incurred. Okay. All right. We could have additions. We could add a new major component to an existing asset, which should be capitalized. So an example, we could add a refrigeration unit to a delivery truck. Okay. Now it's capable of delivering refrigerated items. Okay. That's increasing the future benefit of that asset. Okay. We'd capitalize the cost. Um, includes all necessary expenditures. Remember, everything to bring it to its intended purpose. Okay. For a building addition, this might include cost of tearing down, removing a wall of an existing building. Okay. Improvements, these are just maybe a new component with the same characteristics as the old component, or a new component with some enhanced operating capabilities. Okay. So we have a couple of different ways we could do this: substitution, capitalization at new cost, and reduction of accumulated depreciation. Okay, so they give us a problem here. This is going to be a substitution example. Okay, so Palmer Corporation replaced an air conditioning system in one of its office buildings that it leases to tenants. The cost of the old air conditioning system is 200,000. I'm just going to do 200. And then they said, however, the company has separately depreciated the air conditioning system, which makes sense because that might last a lot different than the life of the building. Okay. Depreciation up to that date was 160,000. So our book value right here is 40,000. Okay. They tell us the old system was removed and taken away. So there is no old system. It's gone. Okay. So we've got to take the asset and its accumulated depreciation out of the books. Okay. The new system was put in for 230,000, which was paid in cash. They paid the entire 230,000 in cash. Parts from the old system were sold for 12,000. Now, this is a big journal entry, so I don't want you to panic when I scroll the screen up just a little bit, okay? Because remember I've said, learn how to attack these little by little, okay? We probably could have separated that. Might be even better if we kind of draw a line there, to kind of show you the separation. Okay, so they got $12,000 cash. That was the 12,000 that they got from the old system. Okay, we're crediting the building, we're removing the old system out. So crediting the asset and debiting the accumulated depreciation. That's our book value right there. Okay, we have a loss on disposal from the difference. Well, we can calculate that because we know we have a loss of 40,000 because that's the book value left, but we got 12,000 out of it. So we take that and difference between those, and your loss went down because you recovered some of that book value. Okay. And then the new one is added, and then cash is credited for the exact same amount. So that might help. I didn't think about drawing that line there when I was going through this prior to doing this video. So I hope that helps. All right, so now we're going to look at another example. The Palmer Corporation replaced the air condition system in one of its office buildings that it leases to tenants. The cost of the air conditioning system was $200,000. It included in the cost of the building. However, the company separately depreciated the air conditioning unit. Depreciation recorded up to date was the depreciation. Okay, there we go. I've lost which line I was reading. The old system was removed and the new system installed at a cost of $230,000, which was paid in cash. Parts from the old system were sold for 12,000. So here's where they just took the difference between the 230 and the 12,000, and they added the asset in there and credited cash for 218,000. If you'll kind of notice, that might be almost, yep, that's almost exactly. If they didn't make all those other entries, then they would have the same amount in each account. Okay. And then they can say this is the third alternative, reduction to accumulated depreciation. So they could credit the cash and then just decrease the accumulated depreciation back down to get the book value that you would on all of those other ones. Okay. Rearrangements, sometimes expenditures made to restructure an asset without any addition, replacement, or improvement. We may create a new capability for the asset, not necessarily extend its useful life. Rearrangement of machinery on the production line to increase operational efficiency, or the relocation of the company's operating plant or office. Okay, those costs are capitalized because they are expected to give us a future benefit. Okay, so here they give you a nice little summary slide on everything we just talked about. And then we're getting close to the end, y'all. Cost of defending an intangible right. So if you have a patent or a copyright and you went to court over that, if you successfully defended that, that amount gets capitalized. Okay. Unsuccessfully defended gets expensed immediately. And that kind of makes sense, right? Because if you successfully defended it, it means your patent is still worth what you've got into it. And you're going to add that successful defense down into the assets. All right. Have another little concept check. If you want to pause the video and look at that, you can. And we have one slide. Well, sorry, we have two slides. The last thing in this chapter is talking about materiality thresholds. When it comes to these capitalizations, they may make a policy up like anything under $1,000 is going to be expensed as incurred. We're not going to worry about it because it's really not going to help, especially if you think about $1,000 You think about something that cost $1,000 and then you're going to depreciate it over 20 years. It's not going to impact your financial statements a lot. So they may have policies like that, whereas up to a certain amount just gets expensed as incurred, mainly just due to ease. Okay, and that is all for this chapter. I'll see you in the next chapter.